Welcome back to another Tech Talk from MarketEdge.com, your source for unbiased technical stock research on over 5,500 stocks and ETFs. My name's Rachel, and with me today, as usual, is David Blake, CMT, here to discuss last week's market and what we should look for as we head into this week. Let's jump right in.
Well, we had a holiday shortened week last week that ended up with the major averages again higher. Dow Jones actually set a new record high on Friday as we continue to see that rotation that we talk about almost every week out of some of the AI-related stocks and into more cyclical sectors. In fact, last week, the strongest sector was actually healthcare, which was up almost 5.25%. And that was followed by financial and consumer discretionary and communication services. Now, the week we started out with Nasdaq having a big move. It was up about 2% on that Monday, and that snapped a 5-day losing streak for the Nasdaq, which again, that was that rotation out of the AI stocks. And you actually had a lot of rotation despite these big moves in the semiconductors. Semiconductor index the week before was down about 9%. And this past week, it was down again about 5 or 6%. So we've had a big correction in the semiconductors, and it almost seems like what the market cares about, especially the Nasdaq, is whether we get news on semiconductors or not, because that indexes will go up 5% in a day, then it'll drop down 6%. As we speak today, I think we're up another 4.5% in the semiconductors alone, while the rest of the market opened up higher, but immediately the blue chips sold off. It was up about 180 points or so, 200 points, got above 53,000 for the first time, and then now we're back down around 52.7 or something like that. So it has some profit taking and some pretty big moves in the Dow. Nike is down 4.5%. Amgen's down 3%. Home Depot, Merck. We're seeing a little bit of a weakness in the healthcare stocks after last week's big move, and also the financials. So again, we're kind of having a shift back to where the semis are going to lead. Then you have a little bit of profit taking in some of the more cyclical things, and then it seems like the next day the cyclicals will outperform. So we're seeing some big swings in the market. That was, we ended up the first half of last week. We saw the market being swung by the semiconductors. I think it was on Wednesday of last week, the semiconductor was down 6.25%. It's very rare that you'll see swings like that. One of the reasons I always refer to the Philadelphia Semiconductor Index rather than SMH, which is the semiconductor ETF, is because the semiconductor index is an equal weighted index. So you don't have these moves by, say, Broadcom or SanDisk, or make the SMH move a little more than what normally you would see with the stocks, although it still is getting a big hike. So anyway, last week, towards the end of the week, we saw yields nudge a little bit higher, nothing big. They keep kind of flirting around with this 4.5% area, which you don't want to see them go too much higher. Right now, the CME group is projecting for July that they think it's going to stay the same. I would expect it to stay the same. I don't think we want to see Kevin Warsh come in on just a second meeting and start whipping rates higher and lower. As of today, we started out this morning before the open, we were about 446, got above 449 again. So we can keep moving around that area. I did notice that this morning that now we have, going into last Thursday, we had about a coin toss whether we'd see a rate hike in September. And now I noticed today that in October, the CME group actually, they're expecting at least a 1/4 point rate hike at that meeting. So we'll have to see how that goes and how the inflation reads are over the next couple of months to see if that's going to happen. Okay, so anyway, towards the end of the week, we saw the Dow Jones and the Nasdaq diverge from each other. A lot of times we talk about negative divergence in these meetings, and that is a great example of it, where you see the Dow outperforms when the generals march alone. And you're kind of seeing that a little bit, but you are seeing progress in the small cap Russell 2000. It's having one of the best years it's ever had, year to date. So that's good. You also have the S&P 500 NASDAQ for the first 6 months of the year posted their best quarterly gain since 2020. So a lot of action. And yet when we had a consumer sentiment came out last week, it was down to 49.5, which is one of the lowest readings we've had in the 48 years that they've been releasing that data. That's with the economy that seems to be doing well. Earnings are coming in great. The market's moving up, and yet people just aren't feeling it, which when you start getting these extremes in some of these indicators, a lot of times it'll be a contrarian view. And the fact that you're seeing consumer sentiment this bad while things look actually fairly good could be good for the stock market going forward. We'll have to see how that plays out. Historically, when everyone's on one side or getting to the extreme, it usually goes the other way. So we'll kind of watch that over this month and next month to see if maybe investors and consumers get a little bit better feel for the economy going forward. Okay, now the technical condition of the market, again, is mixed. We had the Dow Jones, the NYSE, the equal weight S&P 500, which varies from the S&P 500, the normal index, and the fact that we don't have the overweighted tech stocks skewing the numbers on that. So the equal weight S&P 500 hit a new high last week. The Russell 2000 hit a new high last week, while Nasdaq's down for a second week in a row last week. So that diversion is something that you want to keep an eye on. A lot of times technicians will see that negative divergence between the indexes. That's usually a sign that we're getting a little bit toppy. So we'll keep an eye on that. The MACD and momentum indicators for the ones that we just talked about making new highs, they look good. They're improving. The momentum is positive and improving. On the other hand, we have the S&P 500 Nasdaq showing slowing momentum, and the MACD was actually negative for the two of them. And the Nasdaq ended the week below its 50-day moving average again, which is, again, another point that the traders will watch that. I think you did get back above that this morning. I can't check it right as we speak, but that's something to keep an eye on. If we can't get back up there within a day or two above that 50-day, that would be another negative for the market. Just it makes you want to be a little bit cautious of what we're seeing going on. Usually when you see something like that, you may get a little bit of a deeper pullback. Another thing that we're seeing is record numbers in the margin. FIN released their margin numbers, and they're at an all-time high. That is another signal when we talk about contrarian indicators. When things get really pushed to one side, the red flag, because number one, if we would get a little bit of a surprise and the market starts to pull back, if there's a lot of margin debt on the books, then that can induce even more selling as the market pulls back and people get margin calls. And that can swing the selling off, more than it normally would. Just as when people jump into the chase an index or stock higher, we see it get overbought. And in this case, the record margin is something that you want to keep an eye on. Again, because if something surprises the market, it can be a real problem. The underlying market breadth last week was positive. We had the NYSE advanced decline line. Most technicians will consider that a leading indicator for market direction. And I think on Thursday, when the market ended, we actually hit a new all-time high for the NYSE AD line. That was good. And we also saw in the Nasdaq, we almost are getting a breakout to a new high on that. Nothing big. When I say that, it just, to me, is you're not quite, the bulls aren't in control yet. We keep coming up here and pull back, get up here, pull back again, gets up here and starts to pull back. And these AD line charts can actually be looked at almost like a stock chart. You're going to have areas when you have breakouts, especially, as something to note. And over here, we've had this boom, 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 boom. And now we're up here again. But it looks like, to me, like we may be getting a breakout in the Nasdaq AD line, which is not considered as strong of signal as the NYSE AD line, because there's a lot of junk stocks and stuff in the Nasdaq. But it still looks to me like we're possibly getting ready to see another upturn in that, which would be bullish for the overall market. The same side of this, you look at another chart here in the market recap, and here's the new highs versus the new lows. You're seeing quite a bit of a contraction in the number of new lows for the Nasdaq, and that's a bullish signal. That means that less stocks are a little bit of expansion in the new highs is good. I think last week we had 712 new highs in the Nasdaq versus only 357 new lows. So that's up. The week before we had 745 new highs, but we had 648, which you see this little spike over here, new lows. So again, that's a pretty sharp contraction in the Nasdaq, which is a bullish sign for the broader market. Okay, this week we have a full week again, but there's not a lot of stuff going on. Wednesday, we have the FOM will release the minutes from their June policy meeting. Again, they kept rates unchanged at that meeting, and I don't think you're going to see much more. I think Kevin Warsh was pretty adamant that he reiterated that the Federal Reserve wants to keep a target of 2% inflation And that's perceived a little bit as hawkish to Wall Street. That's why we saw a little bit of a back the day he announced that. Then on Thursday, we actually start the second quarter earnings start to roll in. We're going to get PepsiCo coming out the second quarter on Thursday. And then on Friday, Delta Airlines will report their earnings report for the second quarter. And other than that, there's not a lot of economic data that's going to come out. But keep an eye on some of these things this week. I think right now everything looks pretty well. It looks solid. It would be nice to see the Nasdaq come back up above that 50-day moving average here. And as you can see, it keeps struggling right around that. And then the S&P 500 keeps bouncing off of that 50-day moving average. And that's good. That means that we're not getting overbought by any means. And actually, the MarketEdge S&P short range oscillator also is around 3. It's not overbought yet. You want to see that up around 7% before you start getting a little bit more cautious on the market. And I just don't see that right at the moment. So as far as the week goes, I think you just kind of hold on to what you've got. Historically, this has been a positive week in the market. Coming off of the holiday, you start seeing a little bit lighter volume as people go off for their weekly vacations, that type of thing. I think today or the next couple of days will depend on what semiconductors do. That will be whether or not the Nasdaq's going to be able to hold its end of the bargain up and start to move higher or not. But in general, like I say, historically, this is a positive week for the market, and we'll hope that we stay that way. And not the end of this week, but the following week, where we'll start to get the money center banks releasing earnings. That's always a good indicator of how the quarter is going to go. And I did notice that FactSet Research, the analysts that are following the S&P 500 companies, have already raised their earnings estimates for the quarter from where they were at the end of March. So it keeps going up. And again, that's how expansions contract, the fact that the earnings go up and then the stock market kind of goes sideways or slightly up. That will show the earnings. I think we're around a 20 PE, which is not cheap, but it's certainly not overly expensive either. In fact, despite moving higher for the year because earnings have been raised, that means the contractions have actually come in. So the market is actually cheaper now than it was to start the year. I did want to mention one other thing that I had read that I thought was kind of interesting, and that was that over the last couple of months, they talk about the AI portfolio management and how some firms are saying, well, why should we follow things when we can just get AI to do that? And one thing to remember, if you're thinking about moving money over there, all those quant models are basically built on momentum. When you input what you want to have in these things, you're looking for things that are expanding, moving faster, outperforming, that type of thing. You want the rate of change to be over a certain number and everything outperforming the S&P 500. And because when you have these rotations where you're having a slowdown in the momentum stocks, you're going to see those models underperform. So if you are thinking about putting money in there, you certainly don't want to just take all your funds and throw them into a AI quant model, because like anything, it's going to have cycles where when momentum is leading the market, they'll do well. When they're not doing so well, when you're seeing more of a rotation to cyclical areas, they're going to underperform. So it could be something that you want to put some funds into, but it's not got the wherewithal that you want to just keep you involved in the market with AI. That's just something I read. I just wanted to throw that out in case anybody was thinking about doing that with their portfolios. And that, Rachel, is all I have for today.
Well, thank you very much, David. We appreciate it. If you have any questions, feel free to reach out by sending us an email to support@marketedge.com. If you'd like to try MarketEdge, your first 2 weeks are free. Sign up at marketedge.com and we'll get you taken care of. I think that's it for today. Please like and subscribe so you can get more of our weekly tech talks from marketedge.com.